If you are a high income earner, you're probably paying way too much in taxes, you're losing control of your money, and you're probably relying on investments that you don't actually control. Now, what if you could build your own private banking system? One that keeps your money safe, keeps it growing, but also keeps it accessible to use whenever you want, while also letting you multiply that money at the exact same time. My name is Devin Burr. I used to be a high income earner on a W-2 working as a loan officer. And I learned that the more I made, the more they took as far as the government, IRS. I learned how to become my own bank, which allowed me to multiply my income and my wealth. In this video today, I'm going to show you exactly how to do it so you can get out of the rat race. You might be making more money, but you're still on the hamster wheel financially. So I'm going to show you how to get out of that. When you get value from this video, make sure to like it and put your comments in the comment section so I can get back to all of them. So with higher income generally comes higher taxes. You have bracket creep. As you start making more money, you get into a different bracket on taxes and they just take more. You guys have probably heard of the saying, the more you make, the more they take. And that refers to the IRS taking more on your taxes. The highest paying tax individuals, people that pay the most, are W-2 employees that make a lot of money. They just have to pay a ton of taxes. Ones that don't own a business, they're just getting earned income on a W-2. So you've got that, and then you've got lifestyle creep. What I mean by that is you start making some more money, and you know what? You want to get a better car. So you upgrade from your Honda to an Acura. You upgrade from your Nissan to an Infiniti. You upgrade from your Volkswagen to an Audi, whatever it might be. You get a nicer car, which comes with a higher payment, which goes to the bank plus interest. So you get that, you get a nicer house, which comes with a higher payment. So basically, you're making a good amount of money, but you're still on this hamster wheel because the more you make, the more is leaving you. It's leaving, going to these creditors for your lifestyle creep. And then the IRS, the more you make, the more they take with the bracket creep. So here's the solution and what I learned. It's called infinite banking, or so you can see up here, becoming your own bank or bank on yourself. There's a lot of different things that people call it, but basically the wealthiest individuals and the wealthiest families and Fortune 500 companies use this exact strategy. It's not about the insurance. It's not about the death benefit. It's about building your own banking system. And really, it's just all about how one, the life insurance policy is structured, and then two, how you use it. So I'm going to show you guys how to use it, but real quick, how it's structured is simple. You've got regular off the shelf whole life insurance. That is for a death benefit. It's called base premium. So with base premium, that's paying for your death benefit. It does not give you any cash value early on. So that's what Dave Ramsey and Susie Orman say is the worst place to put money. And I would kind of agree with them if you're looking at it from a standpoint of being able to use money because you don't have any cash value. You're just buying a death benefit. What a infinite banking policy is, it's lowering that death benefit. It's lowering the base premium, which lowers the commissions to the agent. And then it's taking what's called paid up additions and overfunding that base premium. So putting more money on top of the regular off the shelf whole life insurance. What that does, it gets you instant cash value. Paid up additions give you instant liquidity that you can use right away without interrupting all the compound growth that a life insurance contract guarantees you. It gets you a whole bunch of cash value and a little bit of death benefit. So you have an ever increasing death benefit the longer you have the policy. So that's all it is. An infinite banking policy is built less for the death benefit, more for the cash value. But because paid up additions get you a little bit of death benefit, you have an ever increasing death benefit. So the longer you live, the bigger your cash value gets, the more you can use it as a banking system, and the bigger your death benefit gets. So eventually, when you pass away, it's guaranteed to happen. Your family gets a big old death benefit payout tax free. So now that you have a bit of understanding how these policies are structured, let's talk about how to actually utilize them. This is one of my policies behind me. This is the second policy I ever did. I've got 15 of them. So, as a high income earner, you can put more into your banking system. Think about it like a bank. A bank gets deposits from people, right? That's the capital they have to use to be the bank, which is lending. That's how they make money. They pay you to hold your money, they pay you a little bit of interest, and they take that money that's yours and lend it to other people for more than what they're paying you. That's banking. The more deposits they get, the more capital they're controlling, the more money they can make. You want to view policies the same way. So, as a high income earner, you have the ability to funnel more into your banking system, which gives you the ability to do more things. So, this policy here is one of my larger policies. You can see here it's $125,000 a year that I can put into this policy. Every single year, when I put that money in, it's not taxable. That money is going to grow 100% tax free, guaranteed. In this policy, it's 4% guaranteed, tax free. It's kind of like if you were earning like 7% before taxation. So 4% guaranteed tax free, plus a dividend that the insurance company pays out based on how profitable they are. So this company, they've been profitable every single year for like 165 years. It's crazy. So they're always paying a dividend, which means with the guarantee plus the dividend, you're generally around 6 to 8% tax-free growth, like clockwork, year over year. All that money is doing that in the background, inside the policy, every single year. Crazy. So I put in 125. The first year I did that, I had access to right away in the first 30 days, because this policy is heavily weighted towards paid up additions. Like I was telling you, I had access to $216,000. Actually, take that back. It was about, and I said 216, I meant 116. I apologize. That would have been incredible. You put in 125, you got access to 216. I meant 116. But that's at the end of the year once you have access to the dividend. It was actually like 109. That's what I had access to right away. So I put in 125. I instantly, in the first 30 days, have access to 109. So now I can put that into real estate. I can put that into other investments to go make more money on top of what it's making in the policy with the guaranteed growth and the dividends tax free. It's just when I use that cash value, the 109, I'm going to be taxed on whatever I do outside of the policy with that money. But inside the policy, there's no taxation. Also, inside the policy, the money is protected against creditors. So, no lawsuits or judgments can be put on this money, which is incredible. It's the safest place for it to go if it's guaranteed to grow, tax free, and it can't be touched on lawsuits and judgments. So, that's just the first year. The second year, I put in 125 again. Now I've got $250,000 compounding and growing, tax free, plus the dividends. So the next year, when I put in 125, you can see the cash value grows from 116 at the end of the year to, at the end of the year on the second year, 241. So that's basically 125 grand. Think about that. I'm just 2 years into this policy, and what I put in that second year, I've got access to that much the second year. That's incredible. That's only 2 years in. And that's because of how the policy was designed. So it keeps going. Year 3, I put in another 125. So now I got more money compounding and growing tax free. And now it grows from 241 to almost 372. So that's $130,000 growth for putting in 125. Now I've got access to more than I just put in that year. And it just keeps getting better and better and better, guaranteed, because all this money never stops compounding and growing. So I'm going to show you guys on this whiteboard exactly what I did with this policy and how I used it to make more than what it's making internally in the policy. This is really cool. Check this out. So this video is for high income earners. I know that not everyone is a high income earner. They can't afford to put this much money into a policy. So I made a video, I'll link it right up here, where you can check out how to do this concept, even if you're on a budget. Check that one out. Let's get back to the video. All right, guys, so I'm going to show you exactly how I used that policy in 2020, coming from being a high income earner, doing loans and mortgages, to then being a real estate investor. So I had a good amount of money I could put into policies, and I wanted to go multiply it through my new real estate business. So 125 went into that policy, right? 125 grand went in. I had access in that policy, the cash value of about 109 right away in the first 30 days. I think it took legitimately like 4 days from when it hit the policy to have it back in my bank account to go use it for the real estate deal. So I took the 109 on a policy loan. I borrowed against the cash value. That makes it to where the money is still compounding and growing because I'm not removing it. I'm just borrowing against it. So I take 109 and I went and did a flip on a property. So a real estate flip. And 125 for that flip is what it took to renovate the property. And I made a profit, of course. But if I would have done that real estate deal regularly without this system, I would have borrowed the 125 from a private lender and I'd have to pay them interest. So I'm treating my policy like the bank. I'm paying it back with interest. So instead of paying the private lender 15%, which is what they were charging, I'm just going to pay that back to my policy, back to my bank. So what I did is I created a note from me to the business, to my real estate business. So what happens is that 109, it's got a 15% loan on it now. So 15% annualized comes out to $1,562.50 per month. So I was paying that from my real estate business back to me because now I'm the lender, I'm the bank. So this deal, this flip took 4 months. So I paid $1,562 a month from my real estate business, which is a tax deduction because it's a business expense, back to me as the lender. $6,250, that's over 4 months, goes back into the policy. What it's essentially doing, it's paying down that loan on the policy. Think of the loan as like a line of credit. As soon as I put that 1562 back into the policy by paying down the loan, I have access to it again. So if I need to use it, I can use it. But over 4 months, I paid myself back 6250. That's interest I would have given to a private lender. I would have lost that money forever. So 6250 over 4 months paid to a private lender is money I'll never get back. That means it can never grow for me and my family ever again. But doing it this way, it goes back into the policy where I control it. It's protected from lawsuits and judgments, and I can use it to pay future premiums. So I can get that money compounding and growing for the rest of my life. So this is what I did, guys. I used that, paid it back over 4 months. So now the policy loan is less. I only owe about $102,000 on the policy loan. So with that flip, I made a profit of about $60,000. So I got my capital back, the 109. That's what it took to renovate the property. I got that back plus the 60 grand in profit. So I got back 169, give or take a few pennies here or there. What I did is I took the 169 and I paid off this policy loan. It was only about 102,750 because remember, I was paying myself back for 4 months, lowering that balance on the policy loan. So since I only owed about 102, I paid that back. Now the full 109 is back in that policy where I can use it again. It's protected from lawsuits and judgments. Nobody can touch it. The whole time I'm doing this, all of that money that I put in is compounding and growing daily, guaranteed, without being interrupted because I'm not removing the money. I'm just borrowing against it. That's it. So I'm doing all this with the additional money I have left over. What I did, guys, is I started a second policy. So I had about 66,000 bucks. I put that into another policy where instantly within the first 30 days, it was built the same way. I had access to about $59,000. So this policy, I got access to 59 right away. This is only 4 months into doing this concept. The first policy, I put in 125. I got access to the full 109 again because remember, I paid off the policy loan. So I actually have $168,000 between the two policies in cash value that I can go use for my next deal. And the beautiful part is I've got more money now compounding and growing, 100% tax-free, guaranteed, plus the dividends. So as you guys saw on the first policy, it gets better every single year. Year 2 of the first policy, when I put in 125, I got access to 125. Crazy. Year 3, 125 goes in. I think I had access to 130. Same thing with the second policy. It gets better and better and better. At this point, guys, I have 15 policies. And the reason why is because I keep getting more of them. And why you have to get more is because when you fund a policy for infinite banking, we build it to where you're hugging up against the line before it gets taxable. You can't put in more. So you decide the max amount. For me, I decided on my first policy it was 125. That's the most I can put in. It'll never be taxable as long as I don't put in more than that. Now, I had this extra 66 grand. I couldn't put more into that policy to get that 66 grand compounding and growing. So I got to start another one. But that's what I chose as the ceiling. I cannot put more than that into the policy. If I do, it becomes taxable. So I'm just not going to do that. I'm going to go use all the cash value between the two policies to go make more. Once I have more, I start a third policy, a fourth, a fifth. At the end of 2020, I had 4 policies. So I learned this concept in March of 2020. My first policy was May of 2020. By the end of that year, I had 4. And the reason is because I used it to go make more money. And then when I made more money, I got more policies so I can get more money compounding and growing. That is why it's so beneficial if you're a high income earner to use these policies because you can put a lot in, meaning you can use them for a lot of things. You can do investments. You can buy cars and get all the money back for all the cars you'll ever buy, drive, and own. I've got plenty of videos about that. I'll link one right up here so you guys can check that out. And you can use them for really anything because you have full control over the cash value, what it's used for, but no credit checks, no financial statements required. You want the money, you get it. And generally, like I said, it's very, very quick to get access to it. One last benefit to being a high income earner, we look back at the first policy that I showed you guys earlier, is when you're putting so much money into your banking system, you're not focusing on the death benefit, you're focusing on the cash value. So the death benefit is inevitably smaller up front. But here's the beautiful thing that I mentioned earlier. Your death benefit grows over time. So check this out, guys. When I put in 125 that first year, my death benefit, if you can see over here, it started at $7.6 million. Okay, that's where it started. So God forbid I passed away that first day, my family would get $7.6 million. Now, as I get older and I keep funding this policy, the dividends, they go towards buying more paid up additions. So the paid up additions, as I told you earlier, they get you a whole bunch of cash value, but they also get you a little bit of death benefit. So you have an ever increasing cash value, tax free because dividends aren't taxed, and an ever increasing death benefit. So check this out. When I am 65 years old, so I'm 30 years into this policy, at this point, the most I can put in is 50,000 bucks. If I put in more, it becomes taxable. So 50 grand I put into the policy. And for one, check this out. The cash value grows from basically $4.8 million to $5.1 million. So guys, what's that? About a $300,000 growth for putting in 50. That's how efficient it gets because the compound interest never stops. But my death benefit when I'm 65 is up to almost $10.9 million. And it just keeps getting bigger and bigger. So I'm leaving a legacy for my family. If we look at the average age is about 80 years old that you live to. So at 80 years old, if I live to be 80 years old, which hopefully I live way longer than that, but at 80 years old, the death benefit is all the way up to $15.2 million tax-free to my family. And I put in 50 that year, the cash value grows from just under 10.7 million to almost $11.2 million. It's about $500,000 in growth for putting in 50. That's insane. That's how efficient the policies get with time. And you're leaving a legacy for your family. So it's a beautiful thing when you're a high income earner because you can do this at a large scale like I was able to do. And if you use it, the cash value, to go make more, you can just get a whole bunch of money compounding and growing inside of your banking system. If you are a high income earner and you are tired of losing money to the banks and to taxes, and you want to build your own banking system like I've talked about in this video, check out the description of this video. There's a free training where I show you exactly how you can do this. And at the end of that training, you can schedule a call to speak with myself or someone on my team so we can help you create your own policy and help you start using it. We don't charge you a penny to do the policy. We actually just make money when you fund it through the insurance company. So we want to help you use this throughout your life. The more we help you, the more you're going to refer people to me and my company. So once you fund your policy, we actually work with you to help you implement it. So check out that video, register for it, and schedule the call at the end. Hope you guys loved this video. If you did, make sure to like it. The algorithm loves it. If you like the video, it'll send it out to more people so I can help more people. And if you liked this video, you're gonna love that one. So check that one out next. Until next time, I love you guys. Peace.